Hi, my name is Ciara Jones, and I'm a senior in Marquette's AIM program. Today, with my mentee Harvey Reed, we will be pitching Richemont, ticker CFRUY. Richemont is the owner of 26 prestigious luxury brands, which are recognized for their excellence in jewelry, watches, and fashion and accessories. Distinguished maisons include brands such as Cartier, Montblanc, and Buccellati. The firm's unique portfolio also includes the leading online distributors Watchfinder and YNAP, which operate in the second-hand luxury market. The firm was founded by Johann P. Rupert in 1988 and is headquartered in Bellevue, Switzerland. Richemont owns some of the most prestigious and established names in the world of luxury. They further distinguish themselves through their highly regarded second-hand market offerings. This is a luxury goods pure play that will benefit from the COVID-19 recovery, and in the long term, Richemont will be able to leverage the world-class portfolio of luxury goods. Richemont is a leader in the manufacturing of jewelry and watches. The Jewelry Masons division, led by Cartier Piaget, reported 142% year-over-year revenue growth in Q1 fiscal year 22. and 43% revenue growth from Q1 fiscal year 20. The double-digit year-over-year growth came from the continued global COVID-19 recovery and their geographic expansion, with sales in the Americas increasing 276% year-over-year. With a net cash position of $3.74 billion USD, Richemont has the flexibility to continue their impressive track record of investments, such as Watchfinder and YNAP. The recent acquisitions of these online secondhand retailers expanded Richemont's exposure to the global secondhand luxury goods market that is predicted to grow at a 10.3% annual rate through fiscal year 25. Purchased in 2018, Watchfinder buys, services, and sells pre-owned watches online and through a network of 80-plus in-store boutiques. The acquisition embeds circulatory into their business model and brings exposure to the second-hand watch market that is predicted to grow at a 10% CAGR through fiscal year 2025. A limited supply of watches in the primary market has tripled the price of many high-end brands in the secondary market, with the popular Rolex Daytona supporting a retail price of $63,000 USD compared to a Watchfinder price of $175,000 USD. The firm's world-class portfolio also includes Cartier, which has growing presence in China with 9 new flagship stores. Strict cost controls led to a 220 basis points operating margin improvement in fiscal year 2021, which will further grow through the restructuring of the Board of Executives to reorganize the decision-making process. With great growth prospects in the luxury second-hand segment and their China profile, it is recommended that Richemont be added to the AIM International portfolio with a price target of $16.13, representing a 19.45% upside. Accelerating profitability in the second-hand watch market will come from a shift to a demand-led business model. It is estimated that pre-owned watch sales, which hit $18 billion in fiscal year 20, will top $30 billion in fiscal year 25, and will become about half the size of the market for new retail watches by fiscal year 25. Watchfinder accounted for 30% in fiscal year 21 of Richemont's online distribution segments. Currently, Watchfinder hosts over 4,000 watches, but will expand inventory through the market of forgotten timepieces, worth about $30 billion. With many pre-owned luxury watches nearly tripling in value, 42% of inherited watch owners do not realize their current value. Watchfinder has partnered with Panerai and other watch retailers to give free full appraisals for watches that are brought into the store. Richemont's online distributor segment is expected to grow 79% in fiscal year 2022, representing 8% growth on a 2-year stack. China is Cartier's biggest market with 41 store locations compared to 27 in the US. A partnership with Alibaba in fiscal year 20 led to robust sales in the Asia-Pacific region in quarter 3 21, with sales up 25% year-over-year. Cartier has the youngest clientele in China compared to any other part of the world, with millennials representing roughly 65% of its customers and Gen Z consumers accounting for 25%. China will become the world's biggest luxury goods market by fiscal year 25, accounting for over half of the global spending in the sector that is currently $309.6 billion USD. After COVID-19 pushed the luxury goods market to contract 23% in fiscal year 20, Cartier has the opportunity to continue growth in China with a $300 million USD joint venture with Alibaba. The jewelry maisons segment continues to be a top-line driver for Richemont after experiencing 34.4% year-over-year revenue growth in fiscal year 21. In the past, Richemont's board of directors was characterized by a high number of executives with 20 members versus 15 at Louis Vuitton and 14 at Kering. Plans have been announced to reimagine a new board profile that will shift strategic decision-making away from the parent company into the individual maisons. Over the next 18 months, the heightened independence of the board will help improve profit margins for each segment and contribute to operating margins of 200 plus basis points by fiscal year 2023. 2 new board members to be appointed include Jasmine Whitbread, who has long-standing interests in ESG issues, and Patrick Thomas, the former CEO at Hermès, who will bring valuable insights to the other division, made up of a number of fashion and leather goods brands. In order to reach an intrinsic value for Richemont, a 10-year DCF model was constructed, using a terminal growth of 2% and a WACC of 7.44%. An intrinsic value of $14.92 was reached. A sensitivity analysis of plus and minus 25 basis points on the terminal growth rate and plus and minus 50 basis points on the WACC ranged from $10.45 to $27.59. Using a price-to-sales multiple of 4.07, an intrinsic value of $18.33 was calculated. Furthermore, an EV to EBIT was calculated using a weighted average of 32.26, resulting in a value of $16.34. By weighing the models 50, 25, 25, a price target of $16.13 was reached, representing a potential upside of 19.45%. Richemont has grown dividends 13.2% on a 10-year CAGR and has a dividend yield of 1.77%.
Next, we have investment risks. Richemont is highly dependent on its ability to respond to major business interruptions, like that of COVID-19, and do so in a swift and effective manner. Secondly, the luxury goods industry is becoming increasingly competitive, experiencing secular changes caused by accelerating digitization. Richemont's success in the future relies upon adapting to meet consumers' preferred retail experience and maintaining customer centricity. Finally, poor economic conditions and a volatile geopolitical landscape may lead to less disposable income for consumers, thus the potential for a decrease in revenues should economic conditions slide significantly.
Richemont is led by Johann Rupert, who was first appointed to the board in 1988. Richemont's executive leadership team includes CEO Jerome Lambert and CFO Burkhart Grund. As mentioned in the third driver, Richemont is currently going through board restructuring with non-executive director appointments of Ms. Whitbread and Mr. Thomas. Richemont has also announced that 3 non-executive directors will not seek re-election in 2022. Recently, activist hedge fund Third Point has built in Richemont a 1.2% stake. Initially, the stock rose about 3%, with many analysts seeing the external pressure as a good thing. The activist action is likely to put the group's capital structure and underperformance in their online businesses in the spotlight, creating a shakeup that could boost its lagging stock price. Relative to its peers, Richemont is trading at a significant discount to the luxury goods market that is predicted to reach $296.9 billion by 2026. The jewelry maison segment will continue to be a top-line driver of growth, yet additional growth can be found in the second-hand market with their Watchfinder acquisition. Recent activist pressure and the restructuring of the board will place external pressures on the company's operations that will help to improve the company's overall margin profile.